If decorrelation is indeed the true quantitative holy grail of trading risk management, it does not mean that your arsenal of available tools should be restricted to this technique alone. Beyond mitigating risk at the portfolio level, a number of other more granular methods and fine-tuning procedures are available to not only supplement but also compound the effect of decorrelation by focusing on hardening individual trading systems. In the retail trading world, this approach is often reduced to its crudest, most simplistic form by way of applying position stop losses. And as I will show you in this video, there are many more ways to make your systems not only safer, but also more prone to generate superior risk-adjusted returns. So let's investigate 10 of these techniques one by one and take your risk management skills to the next level. Unlike portfolio decorrelation, which mathematical outcome is the enhancement of risk-adjusted returns, attempting to control risk at the system level alone will often prove extremely frustrating as a quantitative trader. That is because, if applying volatility countermeasures to a single system will indeed produce lower risk, of course, it is almost always achieved at the cost of a degraded overall expectancy. And for that reason, deciding to control risk straight from the systematic logic of a single strategy will often result in having to pick a side between favoring low risk or high return, but rarely both. With that said, certain techniques can still help alleviate this compromise on performance and get closer to a winner-takes-all outcome similar to decorrelation. So here are 10 of them, going from the most basic to the most sophisticated. The first one involves revisiting how you use price-based stop losses. If you're a newcomer to trading and are serious about it, you need to realize that drawing lines on a chart is not a viable way to manage your risk. If that is still you, then you must know and accept in a hurry that just because you believe that you can identify a support or a resistance to adjust your stop order placement, it will not actually do much else in the long run than convincing yourself that you accomplished something of value expectancy-wise. Using pseudoscientific processes like this one not only cannot be reliably tested or replicated, but for the very reason that they rely on pattern recognition, everyone will also likely see these same levels just as clear as you will on the chart. And this leads to massive stop-loss harvesting like this one. So I'm asking you, how can you genuinely expect to acquire an edge over the market by doing it the lazy eyeballing way, which is what everybody else does? Think about it. The solution is obviously to rely on objectively quantifiable inputs instead. And here are a few super basic examples to step your game up. Let's assume that you're trading long. You could use a close below a given moving average to close out your position, the look back of which you can objectively determine. Likewise, you could use what is called a Donchian channel to do the same. This would take the form of a close below the lowest close or the lowest low of the past X number of days. There is an infinity of variations to accomplish the same goal with price-based stop losses, but every time, the point should remain the same. Whatever you do, express your trading rule quantifiably and test it. If you want to keep using price-based stop losses, then fine, but stop drawing subjective lines on a chart. Remember, if you can't test it, do not trade it. To understand the second technique, you have to acknowledge that price moves in a three-dimensional plane. Price will rise, price will fall, but especially, it will move to the right. And while most traders will obsess over finding the right price level at which to place their stop loss, others understand that analyzing the dispersion of their trades time in the market relatively to their outcome can provide some invaluable insight in finding the correct time stop on their trading positions. Your goal with this technique is to try to capture the bulk of your winners within the average time that it takes for them to successfully complete, and without those that take forever and are likelier to end up in a loss. This is especially true with short-term strategies that rely on rapid profit taking, involving tight take profits and loose stop losses. In all likelihood, the propensity for your winners to take a short amount of time and your losers to take a while until completion is very high. So in this case, you would want to mind for a positive bias by allotting a short time stop to your open positions in order to cut your losses shorter than what your price stop would allow, while leaving just enough time for your average winners to breathe until successful completion. Number 3. Catastrophic stop losses. A comprehensive knowledge of your trading system is required for this one, and more specifically, knowledge of the risk statistics across an extensive historical sample. As I previously mentioned it, applying regular stop losses will have the typical effect of worsening the risk-adjusted qualities of a trading system. But the aim of a catastrophic stop loss is different. It is to minimize the interference of stop losses with everyday trading and confine it to those exceptional circumstances that will require curbing tail risk and covering your strategy against a rogue and sudden financial event events, such as the meltdown that we saw back in early 2020. Here is how this is implemented quantitatively. It can be applied to either trades or entire strategies, by the way. What you will need in each case is the maximum drawdown and the standard deviation of all drawdowns. The idea of a catastrophic stop loss is to be positioned right at the outer limit of your drawdown universe. Let's take a quantified example to make it more palatable. Let's imagine a strategy with a minus 18% maximum drawdown and a 2.6% standard deviation of all drawdowns. You model this strategy over 20 years and 50,000 trades, so your level of statistical confidence is high with this one, and you can afford relying on your historical risk assessment. Placing a catastrophic stop loss in that case could take the form of planning to temporarily cease trading your strategy once its current drawdown has reached one maximum historical drawdown plus 2 standard deviations, or minus 23.2%. The idea here is to use the standard deviations as a buffer to the historical reference in order to make your far-fetched stop loss not only a catastrophic stop for sure, but also one that will reflect tail risk and protect your account equity from the occurrence of an event that would be truly not only out of the ordinary, but also out of anything that was already observed in the past. Now, technique number 4 consists in gradually scaling down the maximum scope of your strategy allocation past a certain drawdown threshold. The idea with this one is to allow the system to invest as much as its theoretical maximum during periods of gains and average drawdowns, and restricting it more and more as the drawdown deviation from average starts to ramp up. Here's a quantified example for you. Let's consider again our previous system with its minus 18% maximum drawdown and 2.6% drawdown deviation as modeled. Now let's also consider minus 6% as the average drawdown. What you could test is the following scheme. You would allow the system to be invested up to 100% of its full capacity for as long as its drawdown remains within one average plus one standard deviation or less than 8.6%. But when the drawdown crosses that 8.6% threshold, then you would cut its investment capacity by 1/4, effectively taking only 3/4 of your regular positions. And should the strategy drawdown increase by another standard deviation, you would cut your position size by a further 10%, say, and so on and so forth. And you would keep doing that up until a drawdown threshold that would essentially bring down the position allocation to 0 and temporarily deactivate the strategy entirely. As you can see, the whole exercise revolves around not being all or nothing in our risk management approach, but rather progressive. One important aspect to note here is that just like with entire markets and indices, the equity of a strategy with positive expectancy does also move in waveforms within its own positive drift. What it implies for you is that you will have to find the right balance in your scaling down model so as not to cut a strategy at the slightest drawdown, which might very well be the very best time to invest, the exact same way as most mean reversion trades work with equities. So be warned on getting too aggressive with it, and do your best to differentiate a mild drawdown that would warrant an aggressive allocation from a nasty looking one that may last longer and require risk mitigation indeed. Once again, it's all about testing while avoiding to fall into the trap of curve fitting as much as possible. Fifth technique on our list today is the index volatility kill switch. Let's assume that you are trading a system that targets stocks pertaining to the Nasdaq universe. Instead of monitoring the volatility of your system itself, as we did it in the previous technique, you could monitor the proxy within which it trades, so in our case, the index. Implementing a volatility kill switch could take the form of an ATR threshold past which you would liquidate all of your holdings and stop trading altogether until the index's ATR goes back under that threshold for X number of days, for example. Alternatively, instead of measuring the static volatility of your index at the close, you could also look into the rate of acceleration of that volatility over a given look-back period as the kill switch signal. The idea remains the same though. It is to determine a certain range within which your market is deemed healthy and worthy of trading your strategy, and outside of which the trading environment is deemed to have turned sour and requires to stop trading the strategy as you wait for the panic to subside. Obviously, this technique can also be applied to single trades as a more refined alternative to crude stop losses. Technique number 6 is also looking for risk management outside of your strategy. It revolves around a dual approach, whereby you would scale down a trading system depending on the spread between two given instruments. Let's imagine, for example, that you're trading a strategy focused exclusively on the airline universe. Clearly, this is not an industry that fares very well during phases where wars are going on or when oil prices are flaring up. So what you could test is how this strategy performs based on the performance gap between the WTI and your airline index, or between the ITA ETF and the SPY ETF over the past X number of weeks. Your goal is to try to find if any of these seemingly logical relationships bears any predictive value as to when to scale down on a given strategy. Now, I need to leave you with a word of caution with this one. Bear in mind that an analysis like this is a correlative one, and as with any correlations, The consequential link of these relationships is much more prone to break than those found using absolute mathematical causation. You will have to also model some kind of fail-safe kill switch for that kill switch itself, just in case the correlation was to fall apart entirely. That is why it is recommendable to only use this technique when the relationship has lasted for decades. Even if actual causation remains to be proven, continued historical persistence shows that there certainly would be some kind of link here that will be tougher to dissipate going forward. Technique number 7 is a corollary of number 6. It still relies on correlation as a way to measure it, but it does involve causation. The process is to establish mechanical relationships between measurable factors and the fate of industries, sectors, and markets as a whole. For example, should you trade only real estate stocks long and short, you could argue that higher rates are mechanically detrimental to the sector, and vice versa. So the scale-down signal for your real estate trading system could emerge from testing a given threshold in the inverse correlation between, say, the Case-Shiller index and the 20-year US Treasury yields. The signal could look like this. If the inverse correlation falls below a given level, then it means that the real estate market outlook or the monetary policy outlook are too blurry, and I can either decide to not trade the strategy entirely or to take both long and short signals in order to remain market neutral. Conversely, if the inverse correlation rises above a certain level, then the respective outlooks are most probably clearer to the market, which is in turn likelier to trade with a lasting bias, and it would certainly be better to focus on either the long or the short logic of my strategy. Either way, the goal is the same, trying to narrow down your trading environment in a way that filters it out in chunks that keeps your strategy active only in times that maximize return and minimize risk. Moving on to technique number 8, probably my least favorite, but it needs to be mentioned because it can be used as a last resort if nothing else works. So why is it my least favorite? That is because it involves non-price-based indicators. Contrary to using pure price motion dynamics as the causative source for building your trading setups, using non-price-based indicators is mostly based on correlation, which makes these signals weaker by design and more likely to degenerate over time. Still, these can become a good fallback solution for as long as you can quantify and therefore test them. For example, you could overlay such exogenous data as sentiment analysis, the put-call ratio of a given index, institutional fund flows, the level of non-commercial futures exposure, or the retail positioning in index options, etc. Once again, the goal remains to be able to use this additional input as an override to existing algorithmic rules in order to either disconnect the system before it would on its own and potentially reducing risk, or have it redeploy capital before the trading rules would allow and potentially increasing return. But here is another word of caution. Using this technique is probably the trickiest because of its non-causative nature, and it will require from you a great deal of experience in order to avoid curve fitting, which would lead you to include an unreliable statistical artifact in your algorithm. Because trust me, if you use brute force to data mine long enough, you will happen to find something that sticks, and novices won't be able to tell the difference. So please only use this method if and only if you already have a great deal of experience in building trading systems. Next up is our technique number 9. This one will require a very thorough knowledge of your trading system as well as an accurate tracking of your execution. And oddly enough, the volatility control tool used in this one will actually be triggered on a discretionary basis. Pretty counterintuitive as you can tell. I am talking about purchasing a put option when it looks like your system is getting dangerously close to its modeled maximum drawdown. Now how does it even make sense from a quantitative trading standpoint? That is because the cost of this hedge should be algorithmically free. Let me explain. What you need to ensure is first that your execution generates an actual performance that over-replicates the expected performance implied by your model, and it needs to do so consistently. If you've been conservative enough as far as commissions, slippage, and other trading friction costs when you created and modeled your trading system, then this should not be impossible to achieve and sustain. After a few months of live trading, you should be able to project with a reliable degree of confidence what your over-replication should generate over the next X number of months in terms of outperformance. I understand this might be tedious to understand at first glance, so let's use a quantified example. Let's assume that you trade a system that generates a return of plus 10% over the first 6 months of live trading. Your model indicates, however, that the system should have generated only plus 8.8% over the same period, net of the cost assumptions of your model. From here, you can extrapolate that you are able to outperform your model by plus 1.2% every 6 months or plus 0.2% per month. This extrapolated plus 0.2% per month is your performance reserve to be applied towards the purchase of a put option whenever your model threatens to drop below its expected max drawdown. Now let's imagine that you figure out that the cost of an option hedge would cost you about 4% of your account over 2 years. What you would do in that case is purchase that option while knowing that its cost would essentially be equivalent to 20 months worth of algorithmic outperformance in order to amortize what you would pay for the option today. In that specific case, you will amortize the option cost even before the option expires. As you know, algorithmic replication should be your #1 goal once you are done modeling your strategy. This is one of the massive perks that comes with it. Using this method is a win-win because it allows you to reinvest your replication quality into a product that drastically and passively reduces your risk, thereby snowballing into further bolstering your replication quality itself. If you cannot tell already, this is as close as it gets to a free lunch from a quantitative viewpoint. And now, to finish off our list, let's talk about cascading systems. At this point, peak quantitative mastery of your algorithms is required. Note that this risk mitigation method moved away from system-level volatility control, but is not quite within the realm of portfolio-level risk management. It is somewhere in the middle. What this process entails is to build a hierarchical stack of variations of the same trading system according to the principle of horizontal decorrelation that we reviewed in this video. These variations should be prioritized in decreasing order of aggressiveness using parametric dialing, with the most aggressive system being the one treated by default, and each alternative system variations standing as a more defensive fallback. This method follows the well-done process of rotational trading and should be viewed as its own systematic overlay. But as usual, this is a balancing act with advantages and drawbacks. The main advantage is that unlike passive decorrelation, the risk mitigation logic here is proactive, whereby a single instance of the same system is traded at any given time as opposed to all of them all the time. The main drawback, however, is that an additional algorithmic logic is required for it to function, thereby adding another degree of freedom that is prone to curve fitting and, of course, a potential point of failure for your stack of systems. For that reason, making cascading systems work requires total knowledge of how the genesis system works and especially why it works the way it does. Now, fail to understand the why, and the likelihood of curve fitting will increase drastically with counterproductive results that might end up degrading your risk-adjusted performance instead of improving it. So that is it for risk mitigation at the system level, guys. Now tell me, how far did we get exactly from this cookie cutter place your stops below the support line BS? I really hope that this laundry list of alternatives did not overwhelm you. If anything, I trust that it massively widened your understanding of volatility control and showed you how much more creative and robust this layer of risk mitigation can get. As I keep repeating it, trading is nothing but risk management. That's all it is. And being able to combine decorrelation with any of these techniques or any other of your own derivatives is what will allow you to consistently generate abnormal risk-adjusted returns, which is all that you should care about as a trader who looks to stay and prosper in this game in the long run. I'll talk to you in the next one.